What if you could invest like one of the richest men in the world? Without being a genius, without predicting the market, and without taking huge risks? Sounds impossible, right? But that's exactly what the Warren Buffett Way reveals. Welcome to Money Library. Today, we're diving into the timeless investing principles of Warren Buffett, a man who turns simple ideas into billions. This book breaks down how Buffett actually thinks, invests, and wins. Consistently. And the best part? His strategy is something anyone can understand and apply. The core idea of the Warren Buffett Way is simple. Don't gamble in the stock market, invest in businesses. Buffett doesn't chase trends, hype, or hot stocks. Instead, he follows a disciplined approach based on 4 key pillars. 1. Business perspective. Think like an owner, not a trader. At the core of Warren Buffett's philosophy in the Warren Buffett Way is a simple but powerful idea. Always think like a business owner, not a stock trader. Most people treat stocks as numbers on a screen, constantly watching prices go up and down, trying to make quick profits. Buffett, however, sees every stock as partial ownership in a real business. When he invests in a company like Coca-Cola or Apple, he is not just buying shares. He is buying into the future of that entire business. This mindset shifts the focus from short-term price movements to long-term value and stability. To think like an owner, Buffett asks fundamental questions that any sensible buyer would ask before purchasing a business. Is the company easy to understand? Does it consistently make profits? Will it still be relevant and needed in the next 10 or 20 years? If the answers are unclear, he simply avoids investing. This approach is closely tied to his concept of the circle of competence, which means investing only in industries and businesses you truly understand. Buffett believes that you don't need to know everything about the market. You just need to clearly understand a few businesses and stay within that zone. This is why he avoided investing in certain industries for years until he felt confident he understood them. Another key part of Buffett's business perspective is his preference for companies with consistent and predictable earnings. He favors businesses that provide products or services people will continue to use regardless of economic conditions. For instance, products like beverages or everyday consumer goods tend to have stable demand, making companies like Coca-Cola attractive investments. Consistency reduces uncertainty and makes it easier to estimate a company's future performance, which is essential for long-term investing. Buffett also looks for what he calls a durable competitive advantage, often referred to as a moat. This is what protects a business from its competitors over time. A strong brand, customer loyalty, cost advantages, or a unique product can all serve as a moat. Companies like Apple, with its loyal customer base and integrated ecosystem, or Coca-Cola, with its global brand recognition, have powerful moats that make it difficult for competitors to take their market share. These advantages ensure that the business can continue to perform well for many years. Importantly, Buffett avoids businesses that are too complex or constantly changing. He believes that risk comes from not understanding what you're doing, so if a company's model is unclear or its future is unpredictable, he simply walks away. Instead, he focuses on businesses that are simple, stable, and easy to evaluate. This clarity allows him to invest with confidence. Finally, Buffett's business perspective is deeply rooted in long-term thinking. He is not interested in short-term gains or market speculation. His ideal holding period is forever, meaning he is willing to stay invested in a great business for decades. By doing so, he allows the power of consistent growth and compounding to work in his favor. In essence, Buffett's business perspective teaches us to shift our mindset completely. Instead of asking whether a stock's price will rise tomorrow, we should ask whether the underlying business is strong enough to own for the next 10 to 20 years. This simple shift transforms investing from speculation into a thoughtful and disciplined process. 2. Management quality. Invest in people, not just businesses. Warren Buffett makes it clear that even the best business in the world can fail if it is run by the wrong people. That's why the second pillar of his investment strategy focuses on management quality. For Buffett, investing is not just about numbers, products, or market share. It's also about trusting the people who are in charge of the company. When he invests in a business like Apple or Coca-Cola, he is also investing in the decisions, integrity, and vision of their leadership. Buffett looks for managers who are not only intelligent and capable but also honest and transparent. He values leaders who openly communicate both successes and failures with shareholders, rather than hiding mistakes or manipulating information. In his view, honesty builds trust, and trust is essential when you are putting your money into someone else's hands. A company may show strong financial results, but if management lacks integrity, it becomes a risky investment in the long run. Another important trait Buffett seeks is rational capital allocation. This means how effectively management uses the company's money. Good leaders know when to reinvest profits into the business, when to pay dividends, and when to avoid unnecessary spending. They treat shareholder money as if it were their own. Buffett admires managers who avoid wasteful decisions like overpaying for acquisitions or chasing growth just for the sake of appearing bigger. Instead, they focus on creating real value over time. Buffett also prefers managers who have a long-term vision rather than those chasing short-term gains. Many companies focus on quarterly results to impress investors, but Buffett looks for leaders who are willing to make decisions that may not pay off immediately but will benefit the company in the future. This kind of thinking aligns perfectly with his own long-term investment approach. Leaders who prioritize sustainable growth over quick wins are more likely to build strong, enduring businesses. An equally important factor is whether management acts in the best interests of shareholders. Buffett favors companies where executives think like owners themselves. This often means they hold a significant stake in the company, aligning their success with that of investors. When managers have skin in the game, they are more likely to make responsible and thoughtful decisions, because their own wealth is tied to the company's performance. Buffett is also cautious of ego-driven leadership. He avoids managers who are overly focused on fame, expansion, or making headlines. In his experience, such leaders often make risky or unnecessary decisions that can harm the business. Instead, he prefers humble, disciplined managers who focus on doing their job well rather than seeking attention. In essence, Buffett's view is simple but powerful. A great business needs great people to run it. Strong management can enhance an already good company, while poor management can destroy even the strongest business model. Therefore, before investing, Buffett carefully evaluates not just what the company does, but who is running it and how they think. This pillar teaches an important lesson for every investor. Numbers can tell you what a company has done, but management tells you what it is likely to do in the future. 3. Financial strength. Let the numbers tell the truth. The third pillar of Warren Buffett's strategy focuses on financial strength. While Buffett prefers simple thinking, he does not ignore numbers. In fact, he relies on them to confirm whether a business is truly strong or just appears attractive on the surface. However, unlike many investors who get lost in complex financial data, Buffett focuses only on a few key indicators that clearly reveal the health and quality of a company. One of the most important metrics Buffett looks at is consistent earnings. He prefers companies that generate stable and predictable profits year after year. This consistency shows that the business model is reliable and not dependent on temporary trends or luck. A company that performs well across different economic conditions proves that it has strong fundamentals. For example, companies like Coca-Cola have historically shown steady earnings because their products are always in demand. This kind of reliability reduces risk and makes future performance easier to estimate. Another key factor is return on equity, ROE, which measures how efficiently a company uses shareholders' money to generate profit. Buffett favors companies with high and consistent ROE because it indicates that management is using capital effectively. Instead of constantly needing more investment to grow, these companies can generate strong returns from the money they already have. This efficiency is a sign of a high-quality business. Buffett is also very cautious about debt. He prefers companies with low or manageable debt levels because excessive borrowing can become dangerous, especially during economic downturns. A business that relies heavily on debt may struggle to survive when profits decline, as it still has to meet its financial obligations. On the other hand, companies with strong cash flow and minimal debt have more flexibility and stability. Buffett believes that a truly great company should not need to depend heavily on borrowed money to succeed. In addition, Buffett pays close attention to profit margins. Companies with high and stable margins are often more efficient and have a competitive advantage. Strong margins can indicate pricing power, meaning the company can charge more for its products without losing customers. This is often seen in businesses with strong brands or unique offerings, such as Apple, where customers are willing to pay a premium. Another important aspect of financial strength is cash flow. Buffett values companies that generate more cash than they need to operate. This extra cash can be reinvested into the business, used to pay dividends, or saved for future opportunities. Positive and consistent cash flow is a strong indicator that the business is not just profitable on paper but actually generating real money. Overall, Buffett's approach to financial analysis is not about complexity but clarity. He looks for businesses that are consistently profitable, efficient in using capital, low in debt, and strong in cash generation. These financial characteristics act as proof that the business is fundamentally sound. In essence, this pillar teaches us that while stories and ideas may attract investors, numbers reveal the truth. A company might look exciting from the outside, but only strong financials can confirm whether it is truly worth investing in. 4. Value investing. Buy great businesses at the right price. The fourth and most powerful pillar in the Warren Buffett Way is value investing. This is where all of Buffett's thinking comes together. After identifying a strong business with great management and solid financials, he asks one final and crucial question: is this business available at the right price? Because no matter how great a company is, if you pay too much for it, your returns will suffer. At its core, value investing is about understanding the difference between a company's price and its intrinsic value. The price is what you see on the stock market every day, constantly going up and down. But intrinsic value is what the business is actually worth based on its future earnings, assets, and overall strength. Buffett's goal is simple: buy when the price is lower than the intrinsic value. This gap creates an opportunity for profit and reduces risk. Buffett does not chase cheap stocks just because they have low prices. Instead, he focuses on high-quality businesses that are temporarily undervalued. For example, even companies like Apple or Coca-Cola can become attractive investments if their stock price falls below their true worth due to market fear or short-term issues. This is why Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." A key concept within value investing is the margin of safety. This means buying a stock at a price significantly below its intrinsic value to protect yourself from mistakes or unexpected problems. Even if your calculation of value is slightly wrong, the lower purchase price provides a cushion against loss. This principle helps investors minimize risk while maximizing potential returns. Buffett also takes advantage of market emotions. The stock market is often driven by fear and greed, causing prices to swing irrationally. When investors panic, they sell stocks, pushing prices down, even for strong companies. Buffett sees these moments as opportunities. Instead of following the crowd, he does the opposite. As he famously advises, be greedy when others are fearful, and fearful when others are greedy. This disciplined mindset allows him to buy valuable businesses at discounted prices. Another important aspect of Buffett's value investing approach is patience. He does not rush into investments or feel pressured to act constantly. If a stock is not available at the right price, he simply waits. Sometimes this means holding cash for long periods until the perfect opportunity appears. This patience is what separates successful investors from impulsive ones. In the end, value investing is about combining logic, discipline, and emotional control. It requires you to ignore market noise, focus on long-term value, and act only when the odds are clearly in your favor. In essence, Buffett's strategy can be summarized in one powerful idea: don't just buy great businesses. Buy them when they are on sale. 5. The Buffett mindset: mastering emotions and thinking long-term. Beyond strategies and numbers, one of the most powerful lessons is Warren Buffett's mindset. This is what truly sets him apart from the average investor. While most people focus on what to invest in, Buffett focuses on how to think. His success is not just built on knowledge, but on discipline, patience, and emotional control. One of the most important aspects of Buffett's mindset is emotional discipline. The stock market is driven by fear and greed, two emotions that cause most investors to make poor decisions. When prices are rising, people become greedy and rush to buy, often at high prices. When markets crash, fear takes over, and they panic sell, locking in losses. Buffett does the exact opposite. He remains calm and rational, treating market fluctuations not as threats, but as opportunities. This is why he famously advises investors to be greedy when others are fearful and fearful when others are greedy. Another key element of his mindset is long-term thinking. Buffett is not interested in quick profits or short-term gains. He invests with a time horizon of years, even decades. He believes that wealth is created by staying invested in strong businesses and allowing them to grow over time. Instead of reacting to daily news or stock price movements, he focuses on the long-term performance of the business itself. This patience allows the power of compounding to work in his favor, turning small gains into massive wealth over time. Buffett also values independent thinking. He does not follow the crowd or rely on popular opinion. In fact, he often goes against it. While most investors look for validation from others, Buffett trusts his own analysis and sticks to his principles. This independence helps him avoid market bubbles and make decisions based on logic rather than hype. It also requires confidence, the confidence to stand alone when necessary. Simplicity is another defining trait of Buffett's mindset. He avoids complicated strategies, complex financial instruments, and trends that are difficult to understand. Instead, he sticks to simple, proven principles that have worked over time. This clarity allows him to make better decisions and avoid unnecessary risks. He believes that investing does not need to be complicated to be successful. It just needs to be disciplined. Finally, Buffett's mindset is built on consistency and patience. He does not try to act constantly or chase every opportunity. Instead, he waits for the right moment and then acts decisively. He understands that great opportunities are rare, and when they come, they should be taken seriously. This ability to wait and then act with conviction is a key reason behind his long-term success. In essence, the Buffett mindset teaches us that successful investing is not about intelligence alone, but about behavior. It is about staying calm when others panic, thinking long-term when others chase short-term gains, and trusting your judgment when others follow the crowd. Mastering this mindset is what truly turns an average investor into an exceptional one. So, here's a question for you. If you had to invest today, would you follow the crowd? Or think like Warren Buffett? If you found this summary helpful, don't forget to like, share, and subscribe to Money Library for more powerful book insights that can grow your wealth. See you in the next video.